Can you give us a little bit of a macro perspective on the market as a whole?
I think our vacancy rate overall in the Inland Empire in general is one of the highest it's been in over 13 years. I'm a very positive guy and like to say, hey, things are getting better, and second quarter definitely was better.
There was the Amazon deal. There's the TikTok deal that you just referenced, creative innovation. What is your opinion on kind of, one, where the rates landed on these deals and kind of what's happening in that Class A space over 500,000 square feet in the West?
Before those deals went down, everybody was like, man, this is quiet. Everybody that was out there just disappeared. And so now all of a sudden those deals go down. Now you have a few buildings off the market.
Who are these groups that are leaving, or what is happening to their businesses?
Whenever you have the restriction of that monetary policy, the M2 supply, it does come back and have effect overall on our spending, which then has an effect on these tenants as well.
The Inland Empire industrial market is flashing a major warning sign. For the first time in recent memory, negative net absorption has crossed 1.35 million square feet in a single quarter, pushing our overall vacancy rate up to 8.94%. Space is returning to the market faster than tenants can take it down. But if you think the entire market is collapsing, you're looking at the wrong data. Behind the headline number is a massive historic divergence. While mid-sized buildings between 100 to 250,000 square feet are staring at a brutal 14% availability rate, the mega warehouse segment over 500,000 square feet just exploded with 2.9 million square feet of positive net absorption. It is a complete tale of two markets. Joining me today to break down this raw Q2 data, expose why certain regions are hitting a wall, and map out the exact strategy you need to survive in the next 6 months is Tim Pimentel, Vice Chair at Cushman Wakefield. He is an absolute titan who has executed over 65 million square feet of transactions in this market, and he's here to give us the institutional reality of what's coming next. I'm Shy Assar, and welcome to Adding Value. Tim, thank you for coming this morning. It's a pleasure to have you here. You and your team at Cushman Wakefield, you guys have a very large kind of institutional big box footprint in every segment of the Inland Empire.
Correct.
And you've been incredibly busy in this last quarter.
Trying to be busy.
Especially with tenant representation assignments. Can you give us a little bit of a macro perspective on the market as a whole, how Q2 shook up as?
Well, overall, Q2 was definitely a little bit better than Q1. I think all in all, transactions are still difficult, but there was more transactions that got done top to bottom. Interesting enough is that our vacancy rate, as we discussed prior to the podcast, we are pretty high numbers. I think our vacancy rate overall in the Inland Empire in general is one of the highest it's been in over 13 years. Mm-hmm. So I'm a very positive guy and like to say, hey, things are getting better, and second quarter definitely was better. But we definitely still have a lot more wood to chop, but I really believe that at some point down the road, things will get much better. But right now, yes, second quarter was great, more transactions, much better than the first, and hopefully we can continue that on.
When you say better, because there was quite a bit of, there were a number of really large deals that were done.
Correct.
Any kind of insight on what those trends were really speaking to?
Yeah, so the numbers that we have in place now, and I know Cushman does our data a little bit different than some of the others. We do not track a number or a deal that's gone down as absorption until the lease commencement date, so we're a little different than our competitors. But of course, you've had the two large Amazon deals that went down, and if you book them as stated at lease signatures, those deals have definitely had an impact on the absorption numbers. But I would say, in general, the 500 at 600 has been pretty strong, and there's definitely momentum there. And we'll talk about more down the road, but the 200 to 400s are definitely the weakest parts of the market right now.
What I've always wondered is, when you see this type of it really kind of started to happen for me when I started to kind of dissect the different segments, right? And then you see a flurry of activity in one segment, mm-hmm. and I always wonder, how are they correlated? Does it end up trickling down into the other segment through one way or the other? In this case, when we look at Q2, we look at, really, as you said, everything north of 500 has been pretty robust in the last quarter. And I guess, what does that mean for the rest of the segments?
It's really hard because if we take it back to when we first were coming off the COVID peak, which was, I believe, June, July of 2022, what we saw from 22, 23, and early parts of 24, we saw the 40,000 and under, 30,000 and under actually were pretty strong because groups were sizing down to create more efficiencies for rent structure. And
are you talking about 400 and under?
Actually, no. I'm talking about 40 and under. I know we're skipping the beat here a little bit, but just to kind of get to my point, that segment was working its way down for 2 years, and it was pretty active. But the bigger stuff was definitely was getting pushed down as well. Everybody at that time was going from rents were $1.40 net, $1.30 net, $1.35 net, $1.50 net, $1.60 net. I think one of the highest comps out there in at 200 was, I think it was like $2, right?
Yeah, almost $2 net.
I think it was the Link deal that they did. And so everybody during that time was just ratcheting their way down to be able to stay afloat, to grab a lower building with hopefully a better rate to survive. And so I think once we got to that point and it kind of got stale, then we saw in 2025 the size ranges from that 400 all the way down to the 5,000 square foot level start to kind of level off where they're all kind of the same. And now you look today, if you go 10,000 square feet all the way up to 400 in both the East and West, respectively, their rates, they're really close. And now we'll talk about more of that in the future, or down the line. But, 10,000 square feet up to 400,000 square feet in the West, you're going to be in that $1.20 to $1.25 gross range. And the same for the East. If you're in, 10,000 square feet up to 400,000 square feet, you're going to be in that 90 cents gross to $1.05, maybe $1.10 gross range, depending on functionality. So they all were structuring down at different levels, but now they've kind of blended, with the exception is the 500 to 700 range. And then, of course, we've got the 800 up the millions, which are at their different levels.
So Juan, when we look at the different sections, when we look at, for example, let's start with 100 to 250,000 square feet in the West. We've had negative net absorption. Vacancy rates are around 10% in that space. Availability is closer to about 14%. Yet in the last quarter, actually coincidentally, you and Tim ended up working a renewal in the Inland Empire West in Fontana, 12005 Cabernet Drive. Can you kind of give us a little bit of insight on how that deal came together, maybe some interesting notes about that deal that can be reflective of the market?
Yeah, sure. That deal actually just got signed last week. Good job, Tim. Good stuff.
It took way too long, but we got it signed.
It took a long time, but I think it was good for both parties. That scenario it's an early renewal. I think the lease really didn't come up until the early part of next year, and it's a situation where the building was part of a larger business park. That park had some vacancy in there, and I think the landlord was just trying to minimize more vacancy coming available. So we did an early renewal. Tim had a relationship with the tenant.
Great.
It was a furniture company based in New Jersey, and we were able to secure them in there for another 5 years.
Yeah, and the interesting thing on that too, and I know this will a topic conversation will come up about some of the sovereign groups that are out there. This particular company came in and leased this building 5 years ago, and this is when we started to see the run of the sovereign groups coming out of China. And at that point, there were all different sizes of companies, large and small. And so this particular group had a very heavy deposit because they did not have a big history. And so there was a large deposit that was required on the initial deal that was done. They've been a great tenant and have paid their bills on time. And they were obviously paying a much higher rate. So I think it worked for both the landlord, minimize the downtime. It worked great for the tenant. We were able to get a reduction on the substantially large security deposit, get it down to something that's a little more marketable, or should I say reasonable. And they're also get a preferred rate too. So I think hand in hand for both landlord and tenant, I think it worked out really well.
Is it a confidential comp, or is it a comp we can share?
I think we can share the comp. I don't remember all the details off the top of my head, but I think the start rate was like $1.25 gross.
Yeah, I think it came out to like $1.21, $1.22 gross. It was a standard 5-year deal, 5 months of free rent, like $1.25 in TIs. So yeah, it was pretty consistent in the market. What we see, as I mentioned, in the West, $1.20 to $1.25 gross all in is kind of where things are landing.
And you said their business model, well, they were a furniture distributor.
Yes, and that's very common, as we all know, with a lot of the sovereign 3PLs that are out there or companies. Furniture is one of the large components of some of the groups coming out of Asia, and this was no different.
I look at, because we've had negative net absorption in that space, that segment. I think it was a little bit over 1 million square feet, 1.6 million square feet of negative net absorption. And it just makes me wonder, who are these groups that are leaving, or what is happening to their businesses? Like, what is the makeup of, I can't imagine that they're moving into a 500 or an 800, maybe some of them are, but it feels like, are they just going away, or what's kind of making up that net loss?
And this is, we're just speaking directly about the sovereign groups overseas.
No, I'm talking about the 1 to 250, the tenants that
just
are,
the tenants in general. Yeah, I think a lot of it has to do just with the impact of the economy. I know, anytime you have higher, for the last couple of years, we've had a struggle of having the interest rates come down. And that's a big factor. It makes it harder on businesses securing deals. It makes it harder on operating cash flow. It makes it harder to get loans. It makes it harder for people to get houses. It makes it harder for people to pay their credit card bills. Whenever you have a restriction on monetary policy, and we've seen the 10-year interest rate over the last couple of years just kind of hover and hang in there. And I know that's also hurt in our business, the capital market side of it. Whenever you have the restriction of that monetary policy, the M2 supply, it does come back and have effect overall on our spending, which then has an effect on these tenants as well.
Mm-hmm.
And I know that that's not the full gist of it. I think also we also went up so high, so quick, so fast that some of the operators are out there that got hit with these higher lease rates just couldn't manage the cycle working its way down. Because that being said, as tough as our market is, we're one of the few in the country. I think us in Seattle are having a hard time, but a lot of the cities out there are doing well.
Yeah.
I mean, Phoenix is doing well and a lot of other cities. So
I'll also add to Tim's comment is if we're in 2026 now, and if you go back 5 years, most leases are 5-year deals.
Sure.
A lot of people took on a lot of space in 21, 22, and as their 5-year leases are rolling, they're just starting to give it all back. I know of a few examples where tenants leased 2 or 3 buildings during the COVID boom, and now that the leases are expiring, they go from 3 buildings to 1 building, or they go from 3 to 2. They just consolidate, and that has a lot to do with all the negative absorption all the space that are coming back.
I would second that as well. That's a great point. A lot of the larger operators that are out there are just have space, and so they're just backfilling.
Mm-hmm.
I work with some large 3PLs out there as well, and they're doing the same thing. There's I work with this specific group. I can't say their name, but they got a few buildings out in the market, and they're going to just consolidate into a few, shrink it down a little bit. I think once they get a handle of that, and some of those give back, they redigest, and and then they can get back in line with their margins, and you see some growth. But it does help if we have less restrictions on monetary supply as well too.
So if I'm hearing you correctly, it sounds like it's just really, given the contrast between the segments between, that smaller to mid-sized building versus the kind of big box, that those smaller to medium-sized enterprises are feeling a level of contraction, and they're reducing their footprint as a result of that.
Correct. And again, I know that you asked me on the podcast to talk a little bit about the bigger buildings, but I can say just by looking across the board, some of that smaller segment now which was not struggling for 3 years after COVID is now struggling. Some of the multi-tenant parks that are out there,
Mm-hmm.
the rates are shrinking. And so that's just a contraction that's just started at the top. It's worked its way down, and now it's finally caught up to the bottom part of the market.
So pivoting to 250 to 500, kind of a similar story in the West.
Yes.
We have 1.3 million square feet of negative net absorption. At least that's what our numbers have shown. Availability of about 14%. You actually, in this size range, did a tenant representation assignment, a client of yours that you work with in Fontana. I believe it was
eFulfill?
eFulfill.
Yes, correct.
Can you tell us a little bit about, one, the lease rate you guys achieved there, and the inception of the deal and kind of the backstory of what happened?
Yeah, so that one was very interesting. Actually, it was a little stressful, to be honest with you. So eFulfill originally was in a sublease that was a 600,000 square foot building that was the sublease of Distribution Alternatives. Chuck in our office represented DA. And so we got eFulfill in there, and the timeline there was only like a 21 month deal. The building had already been racked. They bought the racking from DA. long story short, as we went through, eFulfill couldn't make up their mind what they wanted to do. And, of course, Prologis, the master landlord, they can't wait. They got to make sure their buildings get filled. So they were able to find somebody else to fill the building. So subsequently, it made it very difficult for us. But I'll tell you, I got to hand it to Kevin Apel and Mark Zahner. They had the building on San Bernardino Avenue, which was a 484. It was fully racked. It was previously occupied by HYXT, who had went bankrupt. I think they gave up a couple of buildings.
They did.
A few on Slover as well.
First Mars, I think it was, HYXT.
Exactly. So there was about $1.7 million worth of racking inside the San Bernardino Avenue building. That building was rep by Michael Chavez and David Nguyen and Valentina at Lee. And so they were able to give us a great rate. We ended up getting $1.21 gross. They were flexible on our move to help us get into the new building quickly. We struck a deal fast. They gave us an essentials program set up where it allows us to buy the racking, so it was minimal out of pocket. They also set up to help us sell the old racking and make a great transition. It was very, very, very stressful because we were run up against the clock for the new tenant that wanted to get in and set up. But it was standard 5-year deal, $1.21 gross roughly, 3.5% bumps, 5 months of free rent. We got some early occupancy. I got to hand it to Kevin and the team. They did a really good job of helping us transition to get that done.
Yeah, it sounds like they literally provided a solution.
They did.
And it's interesting because especially in a segment where it's tough to get in a market, and then further in a segment in that market where it's incredibly challenging to get deals done.
Yes.
I think that just kind of shows the extent to which owners may have to go to ensure occupancy.
Yeah.
Because it's incredibly competitive out there and it's tough to do deals.
And I would also add to that too, and since, I tell a lot of our landlords and we are in discussions or meetings, the sovereign groups have now come in strong over the last 5 years. Of course, there's a little bit change in terms of the size and who's out there. They're here to stay. Initially, the credits that came in weren't great, but in the future they will be because they're growing, because they're feeding enough and they're growing off a platform that's completely different from what we had seen traditional e-commerce is, and I'll explain that in a second. But they're not easy to deal with because they have their customs. Our customs are different. They have their way of doing business. We have our way of doing business. So it doesn't always align. So it makes it even more challenging on getting the deals done, exit out of buildings, what's required by them. They're not all up to speed on the protocols that we typically do here in the States. So that also made it challenging. But I think the Prologis guys did a great job.
And as it pertains to your specific client, correct me if I'm wrong, they have a pretty decent footprint.
Yeah, they have a decent footprint. They've got 500 with Goodman in Fontana. They've got the 484, and they're also in part of a few millions are out there. So they got a pretty decent footprint. They're not the biggest. If you want to talk about who's out there that are really taking stuff down, eLogis Tech, which I rep with Jimo Liu out of our Jersey Yacht, they're big boys. US eLogistics, Mike Lee does theirs, guys. We've done some stuff with JD.com, and you've got Western Post. Those are some of the bigger players that are out there that have some good footprint. But yes, eFulfill does have a decent footprint, and they're going to continue to gobble the footprint up. And I know we had talked about this previously about what's driving this growth.
What is driving the growth?
And so I can tell you that 15 years ago, the social media platforms that were not monetized, TikTok, Instagram, and a few others, these were platforms that were targeting kids that were 13, 14, 15, 16 years old. And they were not monetized. They were building the infrastructure. And so what's happened now is that these Generation Z and Millennials are now in their working age. They're 25, they're 26, 27 years old, and they have disposable income. They graduate from college. They're a consumer. And I'm not sure if you know this, but 23 cents, 24 cents on the dollar for every dollar that's spent in the U.S. right now is our e-commerce level. That's our adoption rate. The Gen Zs and the Millennials are 50 and 61%. So double of what the average is. So they are shopping and buying off of these platforms now because this is what they grew up with. these large companies that you see, the JDs, the eLogistech, that's where their growth is coming from. A big chunk
It's
of
incredible.
that. It's incredible. So I know that eLogistech also does handle TikTok. I know that TikTok just signed a
They just
deal
did a deal in Rancho.
With JLL. They also spread out their business as well. JD.com, as we know, is a publicly traded company, ADR, and they're a $10 billion company. They also have their own product they sell, plus they take on contracts as well. So they're utilizing a 3PL side of their business in addition to their own platform. And that's how these guys are growing. And they are different in ways. They're not all the same. They all have their different segments. Western Post does most of their labor in overseas. The locations that they serve here, when the product comes in, it's quickly sorted and out the door, versus some of the other companies like eLogistech, they have their labor here. So they all do it a little bit differently, but either way, I guess the point is they're growing.
So let's pivot to the 500,000 plus segment in the West. This is where we saw majority of the healthy absorption in our market. There were a couple big deals that went down. There was the Amazon deal. There is the TikTok deal that you just referenced, creative innovation. What is your opinion on kind of, one, where the rates landed on these deals and kind of what's happening in that Class A space over 500,000 square feet in the West?
Well, I think the three deals that you mentioned, I mean, two of them are Class A, one of them is Class B. So there is a disparity, and a lot of that just really has to do with the clear heights of the buildings. So the Class A buildings, you know, the one that was leased to TikTok or the one that was leased to Amazon, those are going to have a higher net and gross rate. Those deals, from what I understand, I wasn't involved in it, but I think the Amazon deal was closer to $1.50-ish on the net range.
Mm-hmm.
Whereas the Class B building, the Shea Properties building that leased in Ontario, that one was probably closer, I think it was like $1.20-ish gross.
Mm-hmm.
So there's a big delta there, and it just really has to do with the clear height of the buildings. Tenants can obviously pay up and pay more for buildings that they can, you know, rack to 40 or 44, 42 foot clear.
So I would say, the big box market is definitely interesting, you know, and I would say before those Amazon deals went down, it was pretty quiet. You know, I can look at our listing that we have, myself, Chuck, Bryce, and Chris. We've got 1165 Venture Drive. Great building. It's a Class B building, but it was originally 800,000 square foot build-to-suit for Home Depot. Expansion down the road. Now it's 1.1 million square feet. Fully rehab, 32 foot clear. We're not going to compete against the 40 foot clears. We've got 13 acres on the side. And I can tell you, at the end of last year, we had 5 offers working. Uline was out there. Geodis was out there. There's a lot of different groups that were out there. And then all of a sudden, everything kind of got quiet. But it's interesting how things can turn on a dime. And so we always hear the rumors about Amazon taking buildings down. They come, they go, they're back and forth.
That deal, correct me if I'm wrong, I heard it took 6 months, a year for that deal to make.
Yeah, and the thing too is that they were looking at CT's building in Aguamansa. And then, you know, once they realized they think they had a deal, then they said they want to bring in an operator to run it. So now the credit's going to be different. And there's a lot of different nuances. But, you know, I can tell you, before those deals went down, everybody was like, man, this is quiet. You know, everybody that was out there just disappeared. And so now all of a sudden those deals go down. Now you have a few buildings off the market. So if you take a look right now in the East and the West for, let's call it 900,000 square foot and up, you've got probably roughly 6 buildings, 7 buildings in the West. You know, in Clarion just is now in construction on their building in Chino, Ontario area on phase 2. And then in the East, you've got roughly 7 buildings. You know, I represent LPC on the Banning million square footer out there.
Mm-hmm.
That will come to market soon down the road in a couple of months. I think Steve just announced the Link 1.3 million this morning, the Haynes brand building that's now on the market. So those deals went down and we're like, yeah, great. You know, 2 more buildings shrink. Now all of a sudden, boom, we're back here. And so it's very, very interesting dynamic because it's almost seems, if you take a look, and I got this actually stat from Chuck in our office. He's really good at data and he's the best out there. The guy just knows everything. And he was telling me, he's like, yeah, if you take a look at the last couple of years, 2.5 years, Amazon's really the only ones that have been taking buildings down.
Yeah, I know.
Right?
For the bigger ones, yeah.
For the big ones. It's almost like, okay, if you build a building, are you waiting for Amazon to lease it? Because that's the only guys that have really been taking the buildings down.
Mm-hmm.
And so that's the dynamics. You know, I talk to Walt Arrington all the time. We were always sharing notes. about how he feels about that segment. And he's like, man, I don't know how to feel. 1 month I feel great, and the next month I feel crappy.
Sure.
You know, he's got a 926 at the hub, and has offers on and off the table multiple times. I think Creative Innovations is looking at that one as well. And so it's a very, very tricky dynamic. I think that 500 to 700 is definitely a little bit stronger right now. I'm involved in a few proposals with some buildings out there, and I can tell you there's competition. So the next couple of months, I think you're going to see some 500 and 600s go down.
Mm-hmm.
But I think it is what I guess my point being is that one day I wake up, feel great about the millions, and the next day I wake up and I don't feel so good.
Mm-hmm.
It's very hard to, 2-3 buildings come down that can move absorption numbers pretty quickly.
I mean, the reality is, if you look at how many deals happen per year in that size range, I mean, you're like in a good year, you have 4 or 5 million square foot deals.
That's correct.
And in some years, you don't even have one. So just, there aren't that many. The velocity of tenants that are looking for that much space is just not a large amount.
Yeah.
So what ended up happening in all those groups that were looking at your building at the end of last year? Like, I think you mentioned Geodis and someone else.
Yeah, they just kind of went away. I'm not sure if they lost the pursuit. I think they was chasing Amazon. I know.
Yeah.
Unisco was out there chasing that as well too. Uline, I thought that they may, they've got a combination of 2 buildings, one's with Prologis, one with Majestic. They may or may not renew. I thought that maybe they were looking to get some efficiencies by being under one roof.
Sure.
And then they just went quiet.
Yeah.
So it's really, really, really tough to kind of to mark that out. And I know, let's go back like to 2020, 21. In 10 years before that, we were keeping track of all the stats of the buildings that were being built, and like 95% of the million square footers back then were being pre-leased.
Yeah.
For 10 years.
Mm-hmm.
For 10 years. If a building was going up, before it was completed, it was done. And we would track our users in the market at the time. Our users in the market for million square footers was always between 20 and 25. And anytime it got to 25 to 30, a building would go down.
Mm-hmm.
It was almost like clockwork. We would track that data, and we do a really good job of that. But now it's the case is a little bit different. But I think it's because we ran up so hard, so fast. I mean, we were on a moonshot. You know what I'm saying? It was like a Bitcoin moonshot, right?
Mm-hmm.
So now Bitcoin's down.
Now it's down, yeah. What goes up must come down.
What goes
right?
up must come down, right?
Yeah.
And for you Bitcoin fans out there, don't worry. Keep stacking.
It's coming.
It's coming back.
Yeah.
But anyhow,
4-year cycles.
4-year cycle. But I think we went up too high, too fast,
It's what is obviously fascinating to look at is when you look at the kind of the rate differential between Class A and Class B, especially when you're looking at these bigger buildings.
Yep.
Sounds like, the Class A Amazon facility in Fontana, maybe not hit $2 a foot gross, but got pretty close to it. And the Class B building in Ontario, which is a better location, that 700 and change was closer to about $1.25.
Yeah. That's a lot.
That's a huge delta. And we talked a little bit about this in the last market report we did, and Nick kind of referenced that, the investment, the operational investment these companies are making inside the warehouses are just substantially higher to achieve the efficiencies that they're looking for versus moving into a Class B building.
But I'll say that's just for the bigger buildings, because if you look at like 200,000, 300,000, 400,000 square feet, there is a delta for Class A and Class B, but it's not that big.
Exactly.
You can get a Class A building for like $1.30-ish gross in that size range, and a Class B is going to be like $1.20.
Yeah.
So there's really only like a 10 or 15 cent difference. But as you mentioned, in the million square feet, I mean, that's, what do we calculate? Like 60 cents. That's a big difference.
Yeah, and you actually bring up a great point, because we were running the numbers on this the other day to try to figure out what the delta was between Class A and Class B, and it's compressed in the last 4 or 5 years as the market softened, and the numbers shook out to be around 5%, which is exactly in line with like a 10-cent difference on a dollar, plus or minus. And obviously it's because we're targeting a completely different set tenant profile when you're in the 100 to 500 versus the Amazons of the world. They had a pretty TI requirement too, right? I mean, I'm assuming it was
$14 a square foot or something like that.
Yeah, I'm assuming that's yeah.
I mean, I'm not strong with what we could say, but I'm sure some of that affected the rate. So
sure,
that's a big number. But yeah, it's been interesting to say the least. But I think on a positive note, there hasn't been a lot of deliveries. Deliveries are coming down across the board in general.
Nothing is breaking ground.
Nothing's breaking ground. If you look at land over the last 2-3 years. There's really hasn't been any really sales.
Just land sales to owner users, really.
Just simple stuff. So the bright side is that if we can chop through some of this wood, just from now, this is the full market, perspective, and we start turning the corner, I think we'll eat up some of this stuff quick. We just got to get some momentum back.
For sure.
I think if you look at also what's happening in the coastal markets like Orange County and LA, they're starting to see land sales, and I think that's happening because their vacancy rates actually went down in the last quarter. That hasn't happened in the IE, but I think usually what happens there eventually comes to the IE, but it takes a couple quarters for that to happen.
And I think I mentioned to you earlier in the podcast too, Scanel got awarded a deal in Van Nuys. I think it's like a $28 million deal. They're going through their DD right now, J10-1 and Alex there. So, that was a decent purchase, but it's been outside of that, it's been kind of thin. So, hopefully, we start to see some pickup.
Well, there's been a lot of, to your point, Juan, there's been a lot of talk about advanced manufacturing and the strong rates they're achieving in the kind of LA and Orange County market. And the hope would be that, for us in the Inland Empire, that as rates continue to climb there and vacancy comes down, it translates to migration, which hopefully we can capture in the 1 to 500 range out in the IE.
Yeah, let Anduril take down all the buildings in Orange County and then push all those users out to the IE.
Yeah,
exactly.
A quick note for our listeners. If you're an owner, asset manager, or leasing manager with a 100,000 plus square foot building in vacancy coming up in the next 18 months, I'd love to talk. A lot of assets in this market have been represented by the same legacy brokers for years. Sometimes that works, and sometimes it doesn't. If you're ready for a fresh, aggressive approach to reposition and market your property, please contact us. I'm Shy Assar with Voit Real Estate Services, and let's add value to your portfolio. Pivoting to the 1 to 250 segment in the East, the segment is vacancy rates are hovering around 13%. Absorption was relatively neutral, so I mean that's good. The vacancy didn't get any worse. You have a listing in, is it Paris or is it Riverside?
That is it's technically it's Mobile. It's Mobile. That's the 16875 Heacock First Industrial Building. Well, I guess I could say, just to start off, that 1 to 250 in the East, I got one word: rough. It's been a rough road.
The 1 to 500 in the
1
East
to 500.
is rough.
We can add that too. It's been rough. Landlords. The great part about it is that all the landlords out there, they understand, they know what's going on, and there's a lot of good brokers out there, and they're trying to do what they can. In this particular instance, I remember. So this particular building, it's a cross dock. It's just right on the east side of March Air Force Base.
A 225, right?
It's a 225 cross dock, kick-ass yard, 30-foot clear, fully rehabbed. We have the ability to add more doors.
And low basis.
Low basis. I mean, and
First Industrial, right?
Yeah, Ryan McClain will get super aggressive. And I remember before the heavy downturn, we were so close on. I mean, we had 3 offers at any given time for the longest time, and we just couldn't get any to stick. And we still, even up to now, have people keep coming back and just haven't been able to get anything done. I will say this: the last 8 months in general, even though haven't had a lot of transactions in the East, it's at least better because 18 months ago there wasn't anybody calling. I mean, you might as well just go to the movies and go to lunch and go home. But at least now there's people that are looking, tenants that are looking, groups that are looking, and we are trying to do what we can. But I think we all can agree it's just getting harder to do deals, and you have to really handhold them to try and get them over the goal line.
What would you say the biggest difference is with the kind of users you tend to see in the East versus the West?
Well, you're definitely not going to see the sovereign groups. So the big groups we talked about, JD, eLogistics, US eLogistics, eFulfill, they like to traditionally to stay out of the East, and the reason why is because they want that labor. Their labor is coming from the East San Gabriel Valley, as we all know, and interestingly enough, they will not travel. They like to have the sovereign workers inside
for
the warehouse.
That makes sense.
They don't want to go past the 15. It seemed like pulling teeth in the past. But to have them go past
the 15. Now they're going to the 215, but that's a stretch.
That's a stretch.
Yeah.
So we've had some guys take down some stuff. I mean, Mike Lee did a deal with
in Colton.
Colton with in Clarion, Nicole, her team, then Phil and Chuck, and Andrew Starnes in our office. And so I was actually shocked they took that building.
Yeah, so was I. Because Usually they get to Fontana and they say, I'm not going to go further because all my employees then have to drive, 45 minutes to the building, and they don't want to do that.
And they will not. They would rather sleep in the warehouse and in the West than go out there.
For sure.
And so when he came and brought the deal, we're like, wow. At first we were kind of shocked because, as you know, I work with a lot of these groups, and they will not go past the 15, or like I said, they're starting to kind of venture now, little by little. But it was for the hardest time. It was like the longest time. It was like pulling teeth. It
sounds like it's not even really a function of price, right? And it's like it's not like you can't even drop your rate low enough to convince some of these groups to go that far east.
I'll give you a perfect example. So we're working right now on with a group called SpeedX. They're a pretty big outfit out of China, and we've got some offers in out there on 5-600s, and Prologis has a great building that DA is going to kick back as well. Another building there's two 600 side by sides, and that's in Bloomington, right?
Mm-hmm.
It's not Mo Valley, Paris.
No.
And I'm offering it up to some of our big, larger sovereign groups, and they're like, it's kind of far. It's not far, but that's the mentality.
Sure.
And so, I think now they're starting to migrate more.
Yeah.
Before, but.
Because they realize if they go another 10 minutes, they can get a big savings.
That's correct. So,
but to get them to go from Fontana to like Paris or Moreno Valley, that's very hard to do.
Yeah.
Get them to skip over one city, that's a little easier.
They have poked out there and put their heads in, and they're too far. So even though they know the rates are really aggressive there, you might have one guy squeak out there, but they want to stay in the West.
And what are you guys quoting on your building in Moreno Valley?
So Moreno Valley, we're quoting $1.05 gross. We definitely will get more aggressive than that. We'll look at short-term deals. We'll be very creative, and we have been. And we've had a lot of guys step up to the plate, and we've got a good listing team on that. It's Milo, Ryan in our office, and then Kyle at Colliers, and they do a great job of bird dogging the guys that hit us. We try and, like everybody, try to get unsolicited proposals out there, and then that's all you can do. And then you got to pray that whoever is looking at that building or you're offering it to has the ability to functionally use it with a great rate. But yeah, so we'd probably get down into the 90s gross to get that thing done for sure.
Mm-hmm.
But I think all the buildings out there would. All the landlords are very similar. It's just we need more traction out there for sure.
For sure. So Tim, pivoting to the 250 to 500,000 segment in the East, there's this softest segment in the market. Vacancy rates are about 22%. And you recently represented a tenant, I believe it was called BFG. And a pretty substantial transaction in a lease in San Bernardino. Can you tell us a little bit about that deal, why they wanted to be in San Bernardino? And really, I think what's interesting is in a segment where there's so many options to consider, how did you navigate that assignment?
Okay. So full transparency. So that lease commenced March 1st, 2026. That deal actually was worked on and got inked last year. But I will say this is, and I hate to go back to Prologis, but this was what was really cool. So first off, BFG is a landscape supply company. I'm not sure if this is lucky or unlucky, but they were already in San Bernardino.
Mm-hmm.
And so they were up there off of Georgia Boulevard up on Cajon in some metal buildings, a couple of buildings, and they wanted to go and consolidate facilities to go into one. And so when we went ahead and suggested, hey, let's look at the market, the East is probably where you're going to get your best deal.
Mm-hmm.
Luckily for us, they were there. So they understood that. And I know a lot of times when groups are in the West and they go and look out East, they poke their heads out, they drive around San Bernardino, they see a couple of shopping carts, and they kind of say, oh, wait, maybe I don't want to be here.
Yeah.
And so I said, hey, here's some bills we can take a look at. We actually took a look at as far south as Riverside. We looked at Dato's 350 through 70. He's got with Nick. That's down there in Hunter Park. And went up to and looked at Hillwood's building, which was right next to this building. And they ultimately, we showed them building, and they said, hey, so are you guys comfortable with the area? And they go, this is great. We love this.
Yeah.
It's like, it's actually worse for us up in Cajon area because there was a lot of homeless up there. And the building, they selected the building. The main reason is because it had been lived in a few times and they had all the infrastructure in there already.
Mm-hmm.
All the lines were run, all the drops were in.
All the TIs, all the doors
were already all in because that building has been lived in a few times. They had a great, that building has a great retaining wall. It's like 10, 12 feet high. And because they had big credit. Prologis was like, look, we just want to get these keys off our hands into a big group. So they actually did the lease for a BFG in their existing buildings wasn't going to expire till this year. And I told them originally, we're starting the process way too early. But because the credit was big and Prologis thought, hey man, we might have this building for a while. Let's give them the building. It'll get occupied. It'll keep vandalism potential at a minimum. We'll give you heavy EO. We'll give you some free rent to set up, and we got the deal done.
Do you can you share the full comp?
Yeah, sure. So I believe that comp was at that time was pretty aggressive, and again, it was based on credit. They're a large credit company. I believe we were at 82 cents net. I think the OpEx is on that was
25 probably.
25 cents, somewhere around that range. So it ended up somewhere around like $1, $1, $2 gross, $3 gross, which is right in line where it would be. So if you did a deal out there right now, you're probably going to be in that range.
Sure.
So it all worked out well for both the landlord and the tenant. But I was surprised and shocked. And I told, the company BFG, I said, hey, this is probably one of the best deals I think I've seen in a long time.
Long-term deal?
Oh, that deal was a 5-year deal.
5-year deal.
So it was heavy upfront in on that deal, right, with EO and free rent, but it's occupied. They've now got a big credit company in there, and the East is still tough.
I mean, like you said, that size range is roughly 20% vacant. So, I mean, leasing anything in the East right now at the 300 to 400 is an accomplishment.
100%. And I think, and it just kind of builds on what we were talking about earlier. It's like you want to get good deals done in this market.
Yeah.
It's like you need to provide a solution. Yeah. Like it has to be something outside of the box of just, hey, show the space and let's compete for the tenant. It sounds like Prologis again was able to, finesse them out of their previous lease, make it sweeten the deal for them, and make it very easy.
I'm not gonna lie. When I looked at it and go, holy smoke, this is unbelievable. It made my life easier because I thought I was gonna have to go back out in the market 6 months later, and that eliminated that. So it was cool.
There you go.
Yeah.
And moving into the last segment, again, the big box segment had a pretty strong quarter in the Inland Empire East. Positive net absorption, I think, around 1 million square feet.
That's one deal.
Yeah, a couple deals that went down in that segment. One of them was the Amazon deal. There's an Amazon deal that went down, but you also worked on a deal at roughly around an 800,000 square foot space.
Yeah, that's right. It's Comar.
Comar, a tenant
brands.
you represented.
Yes, correct.
Can you give us a little bit of insight on that segment of the market as well?
Yeah, that was a really neat deal. I really actually enjoyed working on it. It was very hard, and it took a lot of work. So Comar Brands was in a building on Riverside Avenue that Allure owns. And I think that was like 11650 Riverside Ave. It's just
in Harupa Valley.
It's on the west side of
the
15. And so it was dated, and they just needed to get in something that was a bigger clear. Moving forward, so that building just got completed not too long ago, a couple months ago. And so we actually did ink the deal last year, but the process was brutal. And so I think even though that deal, the building just got completed and the deal was inked last year, I think it's still pertinent to what's going on today. So Comar this was a regional search. They were looking in Phoenix. They were looking in Vegas. They were even looking for a short time up in Central Valley. And so they want to own their building. They had just finished a build-to-suit in Atlanta on a building they had just purchased. And so, I really thought this deal was going to Phoenix. They had offers out on buildings. The buildings out there are air conditioned. I think their rates were like 55 to 60 cents net. And right now that size range in Phoenix is tight. I mean, those buildings are leased up, but during this time when we were going through the process, there was a lot of availability. So they had some options. And so the cool thing is that, Phil Lombardo and Andrew Starnes, and Andrew did a great job on the back end of this. He was awesome in the process. So they represented DECA. And so DECA at that time was just barely starting to grade the pad, and they were going to go 40 foot, and Comar wanted 42. And so
in Comar's business model, they're a third-party logistics company.
So now they're a clothing company.
Got it.
So they got manufacturing locations all across the world. They got some in India, some in South Asia, and they manufacture and distribute. This is pretty funny. Baby clothes and lingerie.
Okay.
So they kind of goes hand in hand.
That's,
right?
yeah.
So
Yeah.
a family-owned business from back east, very very nice company, great to work with. And so they really wanted to customize a building. So Deco on the fly we were able to put something together so that they can potentially look to get a 42-foot clear. Since they're barely grading the pad, we were able to now adjust some of the features to be a little more custom, like a build-a-suit. But the kicker was that they wanted to own their own building. So Deco was willing to give them a first right
Wow.
to purchase for 7 years. And they
Oh,
also
wow.
give them tax protection for 7 years.
Wow.
And that was the trigger. At the same time, with that, Comar was planning on installing all solar on the roof. They had already put in process of ordering 50 Tesla trucks, electric trucks. And so now all of a sudden, this becomes a custom build-a-suit in a way. Even though they had already started grading, it kind of was like a semi-build-a-suit.
Mm-hmm.
And that's where the tides turned, and all of a sudden they about face. They had specialty designs in the office. Everything in that building was tailored to what they wanted, down to the last little light. And every little nuance. And so that was a really cool deal because it was really an entitled site that pivoted to give a custom feel. And they were able to get,
that deal actually got signed like the beginning of last year, but it just finally completed. That's why it got counted, right?
Yeah, correct. And so, there's all the way through it, there was a lot of work that had to be done. So even up until this beginning of this year, January and February, there was work that needed to be done. So it was a long process.
Did you say it was a lateral move or was it an expansion?
It was expansion. So they went up a couple 100,000 square feet, and they also went up in clear height. So they were in a 30-foot clear, and then now they're going up to a 42-foot clear. They've got another 400,000 square footer that's in that same area in Hooper Valley. I think that at least comes up in a couple of years or something. And so I'm not sure if they'll take that and roll into this one, but yeah, it was a upsize move on volume and on size.
And so all of the kind of unique tenant improvements they did there, was that coming out of, was that included in the deal? Was that something that they're speccing out of their own?
Yeah, it's a combination of both. They put a little bit of money out there, and they were really good about marking the budgets. And Deca did a really good job of pricing things out and trying to make sure things streamline. And the tough part about that, especially when you're going through the process, is it seems to me, and correct me if I'm wrong, Juan, but construction prices never come down. They always go up. It doesn't matter if you're in a recession, they are always going up. So you've got
the only thing that is variable and all that is whatever they pay for the land. But you're right, the construction prices just keep going up.
It's like nothing's ever the same. It's like if you get a quote on a window today, and next week, even if you're in a deep recession, it's still more. Yep. So that was, I think, one of the toughest challenges because the process was so long. But we got through it, and I think it's still a great note out there. And so, yeah, it was a great transaction.
What was the full comp on that deal?
So that was $1.11 triple net, and I believe the OpEx on that were roughly, I think, 22, 23 cents. So
long-term deal.
Yeah, long-term deal. It's like a 180-month deal. Free rent was inside the term. So yeah, it was. I think it worked out great for everybody.
Do you think do you think that figure today, even though that lease that price was agreed to a while ago, do you think that's still reflective of Class A in the East, north of say 800,000
I'd say
square
for
feet?
a build-a-suit, yes, for sure. And so again, going back to the what we talked about with Amazon and the deals that went down and the feeling of one day you wake up, you feel great about that size segment, and the next day you wake up, you don't feel great. I think because that was kind of like a build-a-suit.
It was one of one. I mean, who else? You couldn't just go take another building.
You couldn't. And we looked everywhere, and you just couldn't do that. So, like I said, either that or they're going to go to Phoenix. And
the Amazon comp that just happened is actually higher than that too. So you can arguably say that the rent actually went up in that size
Exactly.
range.
Mm-hmm. And Phoenix, they were staring down Phoenix at 65 cents net, half the rent.
Mm-hmm.
I forget who I was talking. I was talking to somebody the other day, and they said like 2 years ago, Phoenix had like 15 vacant million square footer, and now there's nothing.
Now they're gone.
Yeah,
it went from here to here, and I think it's a combination of we have a lot of groups leaving California. That's been a trend for 15 years, but it's really speeded up. It's so hard. Insurance is hard. Workers' comp is hard. So all the groups are leaving the state, which is unfortunate. We still have 26 million people here in Southern California we got to service, but the business climate is not great. Everybody talks about that. That's the number one thing, right? Everybody's fed up with it. If I will say this, people are here because they have to be here, the businesses. Most of them, if they could, they would leave. If they could, they would leave, but they can't because there's 26 million people here. Otherwise, they would be gone.
Well, before we kind of jump into kind of, forecast or thoughts for the rest of the year, I think a good question is, you guys, I mean, collectively, and especially you have several listings across many different segments in the market. Some markets are doing okay and some are not as well. As a broker, how do you manage knowing even though the market is soft or you might not have a lot of activity on one of your listings, how do you ensure that you're still servicing your client and they have the confidence in the team to continue the relationship?
I mean, it kind of seems simple, but communication. I am very big on communication, meaning any little thing I hear, I don't wait till the marketing calls come up to speak with my landlords. I am calling them on every chance I get. If there's something that's important, I think that's the biggest thing, is that if a landlord's feeling like they're not getting the attention they need to be updated on information that's in the market. I know that's one thing, like I mentioned this before, that Chuck on our team does very, very well. He is very good about getting updated market data, getting it to the landlords. We're not waiting for those marketing calls. We're in the dirt, digging around, trying to figure out ideas, and then we pony that into our landlords to say, hey, maybe we can do this or maybe we can do that. It seems simple enough, but you'd be surprised how many groups out there don't communicate. And
especially when the market's slow and you're not really getting a lot of warm leads.
Yeah,
it's sometimes some people just don't communicate because they don't think they're really getting anything. But sometimes you have to, like you said, you have to chase down every lead. You have to go and find out which users are in the market. Sometimes you have to, make unsolicited offers, and that shows that you're sort of being proactive for your landlords.
I mean, we can't create what's not there, but you have to at least turn everything over to show that's the case. It's not easy. I've always thought, at least for me, when things are hard, you have to even communicate even more, because you want to make sure that your landlords are aware of every nuance. And so at that point for them, they know that there's no doubt that they have all the information they can, because they have to report to their guys.
Yeah,
because there's pressure on them. So we have to make sure they're aware so they can give those accurate reports, because there's someone above them pounding on them. And so that's what I think about when I say, okay, this listing is struggling. Man, I know my asset manager's got someone he's got to report to or she's got to report to. That's not easy. I mean, there's a lot of pressure on them. So I try to make sure I'm fully aware of that at all times, so that I can try and find the best information. And then we do have a lot of young guys in our office: Grant Arthur, Chris, Allegra, Patrick, and they're all cold calling and doing their things. And we're communicating with them to see how it's looking on their end. And so and that's all you can do, and as long as you're doing everything you can, and then it's all you can do.
Agreed. I mean, I think it's a great answer. And I think one of the things I think about is that, especially in a time where there's not a lot of activity, and maybe I'm just going to simplify it for how I understood it, is like, look, the last thing you want your client or your owner to think is that their broker's not working.
That's right.
Right. And so what you're speaking to is essentially the manifestation of showing, like, hey, we're working out here. We're present. These are the people we're chasing down. And that communication highlights it, so it at least alleviates any concerns that they might have about, effort.
And just so you know, and so we're clear, this tan is from my backyard. I was never on vacation. I wasn't in Cabo, Bahamas.
All those videos I saw on Instagram.
All those videos on Instagram. I was not there.
Those are from last year.
I was working.
The natural. And then the last question, and we always based on the assignments you're working on, the activities you got going, how's your feeling for the balance of the year?
I still think it's going to be a little challenging and a little tough, but I think we definitely saw some positive momentum in the second quarter. Which is great. It felt good to see transactions get done. I think there are going to be more coming up in the fall. I think the West is, within a certain respect, is kind of bottoming out. It's kind of holding somewhere on there. The East.
I actually said that I thought the bottom was in the West. So
Yeah. Okay.
It sort of feels
I'm
that
with
way.
you.
Yeah.
I'm with
There's
you.
not a lot of new construction. Believe it or not, on some listings in the West, you're getting multiple offers, which hasn't happened in years.
Yep.
So
Yeah. So it's good. I'm a positive guy by nature.
You have to be in this business.
You have to be, because
you won't
otherwise
survive.
My wife thinks I'm negative as hell, but that's the different side. That's a different story. But I really believe that. I mean, hey, look, we've been here for 4 years. We can't be at this for another 3, can we? Who knows? But I don't think so. I think we're at a point now where pricing points, and I know we're almost done with the podcast, but we have a great, and I'm sure a lot of the landlords out there have seen it. If not, reach out to me. I'll get it to you. But we have this great point that shows the lease rates from South Bay, IE West, East, Orange County, and a historical 10-year trend. And it shows the average 8% increase trend line. We are now, we saw the COVID years of 22. We are right at the point where we're touching that line now.
Mm-hmm.
And it's very interesting to see that. So now the West, like you said, is pretty close.
So we gave back all the COVID gains.
We've given back all the COVID gains.
Yeah.
They're pretty much almost all gone now. And we're now back to the
trend. The normal trend line.
The trend is like this, and it's spiked up, and now we're right there.
Mm-hmm.
So I like to think that that's a good gauge. Now, when people look at charts, it's data. It tells you what's going on. And so, the way someone looks like a stock chart, it's telling you live data. That stock chart is representative of what data is out in the open world that people can get. So I think that, that hopefully tells us that we're near. We're near from turning the corner.
Looking forward to it, man.
Yep.
All right, Tim and Juan, thank you guys for coming today. A lot of fun.
Thanks, Shy. Thanks,
Yeah.
Awesome. Thanks a lot for having us.
Of course. Thank you for listening to Adding Value with Shy Assar. We'll continue bringing on guests with stories and insights that matter in the world of industrial real estate. If you enjoyed today's episode, please share it with a friend or colleague. And if you're a landlord, tenant, or investor exploring opportunities in the Inland Empire, feel free to reach out to us. We'd be happy to help you navigate the market.